Welcome to Debt Matters. I am your host, here to help you navigate the ever-changing landscape of credit and collections.
And I am your resident credit expert, ready to unpack the practical reality behind the rules.
Exactly. And today we are looking at a specific piece of regulation coming out of the UK.
Right.
It is a consultation from the Financial Conduct Authority, the FCA, regarding credit files.
Yeah, and on the surface, this sounds like your standard compliance update.
Right. It sounds like the kind of thing
Yeah.
you might just, forward to the legal team and completely forget about.
Oh, absolutely. It has that very dry regulatory tone to it.
It really does. But we are looking at this from a completely different angle for you today.
We are.
Because this isn't just about compliance boxes. We are looking at the practical implications for credit control and debt recovery pipelines.
Right, because it is effectively an operational forecast.
Yes.
And just for context, this consultation is open until May. So this is very much a current active conversation in the industry.
Which means now is the time to prepare. So the core news here is that the SCA is consulting on changes to improve exactly how credit information is shared.
Yeah, they're looking at the plumbing of the system.
The plumbing, exactly. The objective is closing those gaps where a borrower's file is incomplete.
Or where it is inconsistent across different agencies.
Right. And our mission here today is to really connect those dots. We want to look at how better data upstream at the very beginning of the process.
How that affects the workload downstream.
Exactly. Downstream in your collections queue.
Because it absolutely will.
So let's just unpack the proposal itself first. What exactly are the mechanics of what the FCA is asking for here?
Well, the mechanics are, they're relatively straightforward in theory.
Even if the implementation will be a nightmare.
Oh, this implementation will take a massive amount of work. But the concept is simple. The FCA wants to push lenders to share the exact same credit information consistently across designated credit reference agencies.
Right, the CRAs. Because
Yeah.
right now you have fragmentation.
A lot of fragmentation. Right now, a lender might report to one agency but entirely skip another.
Or the data might update at totally different speeds.
Exactly, you get this lag. So the FCA's goal is to ensure that when a lender looks at a file, any file,
They are seeing the full picture.
right, regardless of which specific agency they happen to query.
And the intended outcome of all this, according to the regulator, is reducing the risk of unaffordable lending.
Unaffordable lending, errors, and fraud.
Right. Which makes perfect sense from a regulatory consumer protection perspective.
It does.
But let's connect this directly to collections for you listening. Why does a collections manager actually care about whether the credit reference agencies are syncing their data perfectly?
They should care deeply. It matters because the quality of the data at the origination stage.
When the loan is actually written?
Yes, when the loan is written. That data completely dictates the quality of the book you are collecting on later.
Okay, let's break that down.
Think about your arrears inflow.
The new accounts hitting the desk every month.
Right. If lenders are forced to make decisions using more complete files, they are, in theory anyway, granting less credit to people who simply cannot realistically sustain it.
So you are basically filtering out the can't pay segment before they even get on the books.
That is exactly it. You filter them out at the front door.
Because if the lender sees the full picture,
Including debts that might have been hidden previously due to those reporting gaps we mentioned?
right, if they see all of that, they make a much more accurate affordability assessment.
Exactly. And over time, that naturally leads to fewer avoidable defaults.
You are dealing with less volume that was, frankly, destined to fail from day one.
Yes, you are removing that guaranteed failure rate from your queue.
That is a massive shift. And that brings us to the second point, which is disputes.
Disputes.
The classic collections pain point.
It is the biggest drain on time.
You call a customer and they immediately say, that account isn't mine.
Or, you never should have lent to me in the first place.
Right. Or, my situation isn't reflected properly, you have the wrong balance.
And those disputes eat up a massive amount of your operational time.
They stop everything. You have to pause the collection activity.
You pause it, you investigate, you request evidence from the original creditor, you go back and forth.
It is incredibly inefficient.
It is. And the FCA is explicitly linking this new proposal to a reduction in those specific errors.
So if the data sharing is better up front,
The likelihood of a legitimate not my account dispute drops dramatically.
right, note that you said legitimate dispute.
Exactly. People will always try to stall. But it lowers the friction in the actual process. You can verify the truth much faster.
It effectively cleans the pipe before the water even starts flowing.
That is a very fair way to put it. Clean pipes mean fewer blockages for the collections team.
Right. And there's a third element here, which I think is
The
crucial.
vulnerability aspect.
Yes, the human element. This is something that Debt Charity Step Change has highlighted heavily in their response.
They have a very compelling perspective on this.
They point out the correlation between data quality and the poverty premium.
Or what we call debt traps.
Right. So for you listening, let's walk through how that mechanism actually works. How does bad data hurt someone?
Well, think about the thin file problem.
Okay.
If a person is totally excluded from mainstream credit simply because their file is inaccurate, or maybe the data is just missing.
Because the lender reported to a bureau that this specific bank doesn't check.
Right. That person doesn't just suddenly stop needing credit.
The car still needs repair. The boiler still needs fixing.
Exactly. The need is still there. So they often turn to much more harmful, unaffordable options.
Options outside the mainstream perimeter.
Yes. They are pushed toward high-cost lending.
Or completely unregulated borrowing.
Precisely. And that creates a rapid cycle of debt.
A cycle that eventually lands right on the collections desk anyway.
But often in a much, much worse state than if they had just been served properly by the mainstream market initially.
So they come to us with an impossible financial situation rather than a manageable one.
Yes. Step Change's perspective is that accurate reporting actually supports stronger forbearance pathways.
It keeps borrowers in the visible system.
The regulated system.
Yeah.
Where there are strict rules about how they must be treated if they get into trouble.
So if the data is better, we are literally keeping people in a safer ecosystem.
We are. It is a protective measure as much as an operational one.
Let's make this even more tangible. We have identified 3 specific real-world scenarios where this change will play out in the daily grind of a credit professional.
Let's go through them.
Scenario A is what we call the thin file approval.
We touched on this just a moment ago, but let's look at the pure operational impact.
Right, the customers with a very limited recorded history.
Those are often the exact accounts that slip into missed payments almost immediately.
Because the risk model was flying blind.
Exactly. It is not necessarily malicious on the borrower's part. It is just that the risk model had far less signal to work with.
And often those approvals are, let's be honest, somewhat speculative.
They are highly speculative. The lender is taking a punt.
Right. So if reporting becomes much more complete across the board,
you are going to see a sharp reduction in those specific types of speculative approvals.
Because the hidden bad news will suddenly be visible.
Exactly. And for a collections team, that directly means fewer early-stage delinquency accounts.
You know those accounts. The ones that default within the first 2 or 3 payments.
Those are incredibly frustrating to work. And they are very often the direct result of data gaps.
So closing the gaps reduces that specific high-friction volume.
It does, which is a massive efficiency gain for the floor.
Huge. Okay, scenario B. This is fraud resolution.
This is a massive one. Fraud absolutely hides in the gaps.
It thrives in the dark spots.
It really does. If I can get a loan from lender A, and I know for a fact that lender B won't see it for 30 days.
Because of reporting lags.
Right. Or won't see it at all because of agency mismatches.
That could just stack credit.
You can go to 5 lenders in one afternoon. Or you can use a synthetic identity.
An identity that works perfectly on one bureau.
But would flag as a ghost on another. Exactly.
So aligned data is basically like turning on the floodlights in a dark room.
That is a perfect way to describe it. It allows for much faster identification of those suspicious patterns.
And for the collections team, what does that mean on a Tuesday morning?
It means far fewer long-running prove-it disputes.
The ones where you chase someone for 6 months.
Right. You chase a debt for half a year, wasting time and resources, only to finally find out it was a clear case of ID theft from day one.
The new system should ideally flag that much earlier.
Or prevent the loan from ever being written entirely.
Which saves an unbelievable amount of wasted effort.
It lets your agents focus on recoverable debt.
Okay, scenario C. We call this sustainable support.
This is about what happens when the customer is already with you, they are on the books, and they genuinely need help.
They have hit a bump in the road.
Right. This comes down to the affordability checks you run for repayment plans.
The income and expenditure assessments.
Exactly. If you are sitting down or on the phone setting up an arrangement with someone, you desperately need to know their true financial position.
But if the credit file you are looking at is only partial,
you might set a repayment plan that requires £100 a month.
Because based on what you see, they can afford £100.
Right. But that plan fails 2 months later.
Because you didn't see the other 3 debts they're currently juggling.
Debts that were hidden on a different bureau.
So a more accurate, holistic view leads directly to more realistic repayment plans,
And fewer broken arrangements.
which is the holy grail of collections.
Exactly. Because you are making decisions based on total reality, not just a partial, fragmented view.
Okay, so that covers the what and the why.
We know what is happening and why it matters.
Right. Now let's pivot to the what now for you listening.
The action plan.
Yes. Because if you are managing a credit function or running a collections team today, you cannot just wait until 2026 to think about this.
You really can't. You will be left behind.
What is the action plan? Where do we start?
There are a few practical moves you need to consider right now. First, you have to review your workflows.
Specifically, which workflows?
Your customer not known processes and your fraud workflows.
Okay, why those specifically?
Because if the industry data as a whole gets better, your internal processes absolutely need to match that new standard.
The bar is being raised?
The bar is being raised. You need to tighten your internal evidence standards.
You need to look at the handoffs, right?
Yes. The handoffs between your collections floor, your compliance team, and your fraud ops.
Because if the external data you are receiving is cleaner and faster,
Your internal excuse for being messy completely goes away.
the regulator will expect you to act on that clean data immediately.
Correct. Second point of action, look at your playbooks.
The actual scripts and guidelines the agents use.
Yes. Specifically, you need to strengthen your affordability and your forbearance scripts.
Because of the focus on outcome.
Exactly. We should expect a massive regulatory focus on actual consumer outcomes.
If the data is suddenly available to make a perfectly correct assessment,
The regulator will demand that you use it.
you can't claim ignorance anymore.
Right. So your income and expenditure approaches need to be incredibly consistent.
That ties right back to data hygiene as well, doesn't it?
Oh, pre-collections data hygiene is absolutely critical here.
Tell me more about that.
Well, collections performance always improves when your account data is strictly accurate from day one.
Before it even hits arrears.
Yes. I am talking about verifying contact details, maintaining a pristine address history, and keeping crystal clear audit trails of consumer consent.
Because if you treat data hygiene as a later problem,
You are literally just building a massive backlog of unworkable, difficult accounts for the future.
you are setting your future self up to fail.
You are. And there is another point here regarding escalation logic.
This is a subtle point, but a vital one. Let's dig into that.
Yeah. If market data becomes vastly more reliable, automatic escalation on disputes becomes much riskier.
Okay, let's explain what automatic escalation is first.
Currently, if a customer disputes a debt, you might have a software process that automatically escalates that account to a legal track or a field agent after, say, 30 days.
The machine just pushes it forward automatically.
Right. But if the entire market is moving toward this highly accurate shared data model,
The aggressive automated escalation on questionable data becomes a major compliance risk.
exactly, because you should have checked the newly available data before escalating.
So you might want to review and actually reduce those unnecessary automated triggers.
You need to put more manual or data-driven checks in place before taking aggressive action.
That is a great tip. Finally, there is the portfolio watch.
The strategic view, this is for the directors and department heads.
What should they be watching?
You have to watch the demographics. If approval rules tighten up at the front end for thin files,
Because lenders can finally see the risk.
right, then the actual demographic mix of your new accounts flowing into collections will completely change.
The overall risk profile of your book will shift.
It will. And that means the strategies you currently use to cure those accounts,
They might not work anymore.
they might need to change entirely. You need to watch the daily intake to truly understand what kind of book you are building for the future.
It really highlights how interconnected this whole ecosystem is.
It is entirely connected.
The rules shaping lending data today, right now, in this consultation, they are going to absolutely dictate the arrears volumes of tomorrow.
That is the ultimate takeaway here.
Well, this reads like a dry regulatory consultation.
It is effectively a detailed operational forecast for anyone managing a UK portfolio.
It tells you what is coming.
Hmm.
But there's one final thought I want to leave you with. Something that builds on all of this.
Oh.
Think about the debt sale market.
Okay, the debt buyers.
Right. If you are buying a portfolio of bad debt today, you price in a certain amount of risk based on bad data. You assume a certain percentage of those accounts are just ghosts or errors.
That is true. The pricing models reflect the data quality.
So, if the FCA succeeds, and this data becomes pristine across the board.
The valuations change.
The valuation models for the entire debt purchasing industry might have to be completely rewritten.
The margins will shift. That is a fascinating angle.
It is something for you to mull over as you review your own pipelines this week.
Absolutely.
We will leave it there for today. Thank you for listening to Debt Matters.